Good evening and welcome to the property edition of Your Money, Your Call. It's great to be back for another week of property information. I'm Margaret Lomas. In news this week, the release of the Bendigo Bank REIA Real Estate Market Facts Report shows house prices grew by almost 6% in the December quarter 2013, and the upswing is likely to continue. Peter Bushby, President of the Real Estate Institute of Australia, says the outcome will give property owners a reason to smile. Solid results for Sydney and Melbourne as well as strong performers in Perth, Brisbane and Darwin in the last year's final quarter have proven that some markets are well into a growth phase. The weighted average capital city median price increased by 5.7% for houses and 4.5% for other dwellings. And Brisbane housing is up to 60% more affordable than other capitals, according to Place Advisory. Brisbane's median apartment price of $383,000 makes it 26% more affordable than the Melbourne median of $481,000. Brisbane's figure is also 45% cheaper than Sydney's, where the median price is $557,000. RP data figures show there's an even greater gap in detached housing figures, with Brisbane almost 60% cheaper than Sydney. Brisbane's median house price is $480,000, while Melbourne is $610,000 and Sydney's is $765,000. The Brisbane market is generally 12 to 18 months behind Sydney in the property cycle, and with Sydney having run hot last year, the Queensland capital is now set to lead growth over 2014. With me tonight to discuss these stories and answer your questions is Michael Teys from Teys Lawyers and Brad Beer from BMT. So if you do have a question for anyone on the panel this evening, you should get it in nice and early by either calling us right now on 1300 30 34 35 or by emailing it to me right now at property@skynews.com.au. But let's not waste another moment and get started with tonight's program. Welcome to the program to both of you.
How are you?
So what do we both think about the hot market at the moment, and do we support the general consensus that Brisbane is the next place to go? Michael?
I certainly do, Margaret. I think Brisbane is starting, with the possible exception of some inner city areas. There's some inner city apartments that are plentiful, but with the exception of those, I think in and around Brisbane is great.
And Brad, what do you think?
Yeah, I like the concept of Brisbane. I think and the housing being highly affordable. A lot of the things that probably I own are houses and not necessarily new things. Not that that's the only thing to buy, but being up there, I remember late last year looking at some new projects, doing some work on those, and you know, the $500,000 or $450,000 two-bedroom unit in the new project is sitting around $450,000 to $500,000 established 3- and 4-bedroom big houses on big blocks. So I kind of like those.
Yeah. And I think that's the thing, isn't it? The affordability, the lifestyle, the temperate climate. Michael, you're a Brisbane boy originally, so you would know what that's like. And I think there's a lot of things about Brisbane that are changing too. It's really growing up. I feel that whenever I go there, you know, in a way that 10 years ago you would go to Brisbane and it was still a little bit of big country town. It's growing up, lots of good lifestyle things happening there, lots of good cultural things happening as well.
Yeah, lots of good work being done in and around the valley, James Street, and I think over to Balmoral, where I used to live, Balmoral, Morningside, really lovely streetscapes there.
Yeah, perfect.
Lovely village feeling.
And seeing some really good increases in prices. A friend of mine owned in Morningside and, you know, in a short period of time got a pretty good return for their property, and I think there's going to be plenty more going on. Let's go to the phones, and Michael from Sydney. Welcome to the program, Michael.
Good evening, Margaret, and good evening to the panel. I've got a question about granny flats in Ipswich. I've got a property up there, and I understand that the local council has relaxed the laws or the rules around that, and you can now rent it out to people who aren't family members. I can see perhaps the benefit from a yield perspective, but I'm not convinced that, you know, putting in $100,000 to build a granny flat will necessarily get you that back in value of the property. Just curious to know what you guys think.
Look, it's a great question to apply all over Australia. WA has just brought in the granny flat laws. Brisbane, I don't think it's been passed yet, but it's certainly going up to be passed Queensland-wide. And we've seen it certainly happen here in Sydney. I think there are benefits and drawbacks of the granny flat arrangement, Michael.
Yeah, I think it changes the it changes the real character and nature of the property, doesn't it? So if it's going to be, if it's a prized house in possession, I think it can make it a little bit almost boarding house-ish, if I can use that term, which might destroy some value longer term, but in the short term the numbers can certainly be made to work.
From a depreciation point of view, Brad, there's plenty to be happy about.
Look, yeah, granny flats, you spend some money on construction, you're not buying any more land, it's got some good numbers in relation to depreciation because it's new, you're just building it a lot of the time. I still am, you know, I think in Sydney it often works because we have such high rental in comparison to many other places, like, and the values are higher. I think your point about the type of property you do it on is very important. So if it's a really old, you know, great old girl, I suppose you'd say, property, then you're going to do some damage to the value of that. Trying to get an extra $100,000 out of value is always a struggle. In Sydney it works a little bit better. Some of my properties, probably in Hunter, I've looked at them in the past, and they don't really work from like, I'll probably get the rental, but I won't get the capital value out of the property, so it's not worth putting the money into it.
I think a lot of people get a little bit misled when they're doing any kind of renovation, and people automatically think that if they spend $50,000 on a renovation they're going to get $80,000 back in value, but it's very often less, isn't it, Brad? Very often spend 50 and you might only get 25 increased value.
And it's really got to be the renovation, depending on what the property is, as to how much you can spend. And when you're buying and thinking, you know, and there's plenty of shows that say we bought it for this, we spent this and we got this. Now, what you spend on that renovation is very important, and what that end value could be should you spend X is really what you've got to look at before you actually go and renovate. And the other problem is we all start renovating and get in there and go, I want to make it look beautiful, as if I was going to live here, and that could potentially cause problems.
Look, Michael, I think you're spot on. Spending that $100,000 very often doesn't result in $100,000 improved value, and I think it rarely would. I think you have to be careful about what you build it on. Many people in the western suburbs here, where people tend to live in duplexes in some areas anyway and don't mind that dual occupancy living, they really work well, and I've seen people actually improve their rental returns. I knew someone who had a small ex-council house, put a granny flat in the backyard in Ermington, and ended up with $600 a week rent from that granny flat that cost them $115,000 to build. But they certainly didn't add $115,000 to the value of the front property. They added $50,000. Sometimes it can actually take value away. People don't want to have a granny flat in their backyard, so it can impact on value. If you can get a really good rent return on it, build it. Get that good rent return, plough the money into the debt and get it paid off, so that you're buying equity that then allows you to leverage into more property. Overall, it can then be a strategy that has a great bottom line profitability. Our first email tonight comes from Fabian with a really interesting question about an unusual investment. And he asks, hi Margaret, what are your views on investing in either in parking spaces, either existing or obtaining land in high demand areas and constructing a one-level open lot or a multi-storey lot? I've recently read articles that suggest that parking space construction has been halted in Brisbane CBD, and therefore there are no more spaces to be built. I've also read that parking spaces don't really increase in value over time, but the yield is fairly high and associated costs are much lower than traditional property. Is it something worth investigating? Where, who, what would be the best place to start? Michael, when these first came out, someone asked me about them and I said, no, don't invest in a parking space because they can't go up in value. And the ones in Sydney kind of tripled in value, and it was the worst advice I've ever given to anybody. But they did reach a peak and then they can't go up from there. And of course, there's other issues with them.
I think the thing, Margaret, is it's a piece of commercial property. So a lot of our viewers are residential property investors, and they'll look at it from that perspective. It can't. It's a piece of commercial property, so it should return like a piece of commercial property would, with a higher risk return formula. So you should be looking double digits, not 6 or 7s. And the other thing is, very often if you're buying into a strata-titled parking centre, you're really putting a lot of faith in the operator. So you're actually investing in a business, not a piece of property. I think they're fine if you're going to use them yourself, or they're adding value to a residential property in the city without parking. I think that's great. A great idea, but as an investment per se also triggers some managed investment issues, which is very expensive for consumers. So some things to watch there.
Just quickly, Brad, any depreciation on a car space?
Well, yes, you do get some depreciation, and sometimes you own part of the common areas like lifts. So on a depreciation per purchase price, often it doesn't work out too bad.
Oh, okay. Well, that's good to know. I wouldn't have said that. Last thing to think about, Fabian, is that the banks aren't going to lend to you on them. I don't know a bank, and certainly a bank can call me if they do it, but I don't know of a bank that will take a car park as security for borrowing. And so it can, and you can use your own home to raise the funds, but then you're tying up that equity in a riskier investment, and it's not available to do something else. So just keep all of those things in mind. Thanks for tuning in, and don't forget that this week, as usual, we are continuing with our question of the week, and this is your chance to get hold of a copy of one of my books. Ask a question and you could receive a copy of my brand new book, How to Achieve Property Success, which is the complete guide to property investing. Call us now on 1300 30 34 35 or email property@skynews.com.au with a question, and then make sure you watch at the end of the show to see if we pick you. It's time now for us to take a short break. Don't go away. We'll be right back. Welcome back. I'm Margaret Lomas, and in the studio tonight I have Michael Teys from Teys Lawyers and Brad Beer from BMT. Now, if you have a question, call us right now on 1300 30 34 35 or email us on property@skynews.com.au. Andrew from Sydney, how can we help you, Andrew?
Yeah, hi guys. I've just got a question with regards to depreciation reports. I recently had one done on a property, and when I got the report back, I wasn't incredibly impressed with some of the figures. So I had the report looked at by another company, and they've said they can do a desk job for me for basically a much lower fee. Now, they said if I could get the inspection data and photos from the first company, just for, I'm guessing, liability reasons, that would make their job easier. Now, the first company is refusing to give those to me. Do I have any rights or ability to get that data from them to enable the second desk job to be done, or do I have to get another full inspection or full report done again?
Okay, well, let's go to Brad Beer, who, of course, is the one of the partners at BMT and Associates, and he can talk us through what should happen here.
Look, Andrew, in any situation, if you're unhappy with the numbers, I'd be going back to the first company and asking a few questions about, look, but then sometimes they're going to say that we are the expert, we do believe in the cost we put on the project, and professionally that's what they should be doing. If I was company number 2 in any way, I wouldn't want to do it off the data collected by someone else. I want to actually do my job myself. If there's any problems, see, often quantity surveyors don't really understand depreciation very well. Quantity surveyors know how to estimate construction costs, but sometimes the expertise in depreciation is a little bit different, and how they treat the cost is different. However, what you have to stand on from the first one is probably not much. There's probably some questions to the Australian Institute of Quantity Surveyors, who are our governing body, about that, but I don't think it's going to help you a whole lot. I would be, if I was number 2, I would definitely be wanting to visit the property and start again rather than rely on some other information.
I agree. What do you think, Michael?
Just from a legal perspective, I think, Andrew, you'll find that the first company has the copyright and the ownership of the data and the photographs that were taken. So I don't think there's any basis upon which you'll be able to force them to give that to the second supplier.
I can understand that as well. Andrew, well done, though, for questioning any depreciation schedule. It's always a good idea to have a good look over them. But remember that if you're wondering about what the costs are, I'm not sure whether you have any expertise in this area either, but I just wonder what you base that on, because you might think there's a value to something, but remember the way a valuer is valuing them, any of your chattels or the things, the plant and equipment is based on a second-hand value, and the construction costs are based on those original construction costs, not what it would cost today. So I'm just wondering whether or not you're thinking that might be what the difference is. But definitely, if you're going to go and have another one done again, you will need to pay for it all over again.
And I do think that's a very good point. But on what basis of questioning, whether it's just questioning the construction costs or you're questioning the rules by which it's prepared under, because often that is what gets wrong. Construction costs, quantity surveyors should know how to estimate, and so from that point of view there shouldn't be any problems with a quantity surveyor, providing they know what they're doing and they've been to the property and looked through that. But whether the rules are treated properly afterwards is the only thing that's a real question.
Yes, okay, and you should be able to tell that by reading through the report as well. So,
to some extent.
Graham, you're from Nunda. How can we help you tonight, Graham?
Oh, hi, how are you, Margaret?
Good.
I was just fascinated by your comments on pricing in Nunda in the Switzer report, where you were saying that you can pick up, 3-bedroom, 4-bedroom houses for 300 to 400,000.
Well, they're actually in the 500s, but yeah, I think that was just a...
I think you're a long way off.
Yeah, they're
I
definitely
just sold an investment property for 3-bedroom, 1-bathroom in Nunda for 610,000.
Well, you did very well then, didn't you? So well done.
I think, the other point I'd like to make is you're still referring to Brisbane as a small country town.
No, I said it used to be many years ago.
But you're still mentioning it. I think, Margaret, you're slightly behind the curveball when it comes to Brisbane property.
Thank you for that.
Thank you.
Graham, thanks for calling. Bye. So, Michael, what do you think? Obviously no longer a country town, which is what we were saying, but at some stage there, it really had the feeling of a big country town kind of a feel.
And that's often said about Brisbane, but... people get a bit parochial about their towns, and it's all relative. I mean, of course, a lot of people like living in Brisbane for that very reason. A lot of people like living in Brisbane because the median house price is 60% less than Melbourne and Sydney, as we were reading about in the press today. So, every cloud has a silver lining, and while some people will see that as a slight on the town, other people will say, you know what, that's exactly why we like living here.
And I love Brisbane. I'm probably one of its biggest proponents and have been for many, many years. I've invested in Brisbane for a long time, and anyone who's from Brisbane will know that it's a town that I've often talked about and talked up and talk about how much I like not only being there, but how I find the population very amenable and very welcoming. And, some of my best friends live there as well. So I think you possibly today, Graham, you may have misunderstood what I was trying to say about Brisbane, one of my favourite towns in Australia today, and certainly a place that I think we should all be investing right now. If not Nunda, then certainly there are plenty of places that we can be investing there. It's time to take another break, but if you do have a question for us, call and you might get a copy of my brand new book, How to Achieve Property Success, if we read out your question and select you. Now, all you have to do is call us on 1300 30 34 35 or email property@skynews.com.au and make sure you watch at the end of the show to see if you're the lucky person. We'll be right back. Welcome back to Your Money, Your Call. Here with me tonight is Michael Teys from Teys Lawyers and Brad Beer from BMT. Call us now with any property question on 1300 30 34 35, or you can email us on property@skynews.com.au. Jean, how can we help you tonight?
Oh, hi, Margaret. Can you comment on prospects for New Farm, which is close to the Brisbane CBD,
yes,
and Moray Field, which is about 40 kilograms north?
Yes, absolutely. Now, of course, Brisbane, we know how much I love Brisbane, thriving metropolis that it is.
You've rethought your position on
rethought my
Brisbane
position.
over the break.
Thriving metropolis of Brisbane. Now, of course, New Farm, you were just sort of having a chat about New Farm. New Farm, about 6 or 7 years ago, had this real burst of interest about it. And it's a former industrial area, or certainly parts of it was former industrial area. And then it sat flat for quite some time. Now we've got apartments going in, lots of conversions and interest coming back into New Farm. What do you think about New Farm?
I like New Farm. It's very livable, lots of warehouse conversions, so there's some really interesting apartment property, as well as new, and the James Street precinct with good fruit and veg, interesting sort of shops is good. There are some building defect issues in some new apartments around New Farm, and there is of course the issue of flooding and the Brisbane River and electricity boards and things being stuck in basements well below the water plane. So just be careful on that on some of the newer apartments, and check all of the search reports for building defect issues. But so long as, and that's a general caveat for all property these days, but so long as those issues, and I'm particularly aware of some around New Farm, so be careful there, but apart from that, really good, I think.
Now, Brad, Moray Field is up in the Moreton Bay Shire, part of that Kalanga area, Moray Field. Some would say, and I not saying that I agree with this. Some would say that Morayfield was the suburb in that group that probably was sort of the least, or amongst the least favourable. So slightly cheaper prices there, but and some new developments, but certainly coming up. And that whole area there, of course, is growing quite wildly. Are you familiar with it at all?
Not highly, but I guess the fact that you say Morayfield was the less desired place, talking about that, I own properties in the less desirable place quite regularly because they're close to the desired place, and the dollar in is usually a little less. Doesn't mean I always go for the cheaper properties necessarily, but if that's what you can afford, then there's going to be certain people that do want to live in that space.
Michael, and like Caboolture, you're quite familiar with that whole area.
I like Caboolture, had some properties there for a long time, and Morayfield I think was attractive for the same sorts of reasons as Caboolture was. Morayfield slightly more residential. Caboolture's got the services town now. But Morayfield, I think, would be good. I think what's interesting about Jean's question is New Farm and Morayfield are very different suburbs for investment properties. I mean, New Farm is probably these days more likely to be an owner-occupier property, empty nester type place, whereas Morayfield is definitely rental basics.
My thoughts exactly, Jean. If you're talking about owner-occupying, then New Farm is your place. If you're talking about being able to invest in something that will have some really good growth under it fairly quickly, as well as a good rental yield, without you having to pay the high prices, then Morayfield really stacks up. There's a lot of infrastructure that's been going in to bring that area essentially closer to Brisbane in terms of the transport corridors and the public transport as well. And so we are seeing a lot happening in that area. We did see really good growth there a while back. We're seeing it coming through again. And I think if it's purely an investment, Morayfield would actually be my choice out of the two. But if it was somewhere to live, then I'd definitely live in New Farm every minute of the day, particularly since it's in my favourite town of Brisbane. Chen's question is right up Michael's alley this week. It's about hotel rooms, and he says, "Hi Margaret and panel, I have a question about my property investment. I bought 2 studio apartments off the plan in Newcastle City, the Star Hotel apartments, which are 22 square metres for $206,000 each. The expected rental return is around $270 a week. Is this a worthwhile investment given its capital growth potential? The contract has been signed, however I haven't paid anything and I'm having second thoughts about this investment." And well, he should.
Well, he should. But firstly, I'd say, look, this is not about the particular property, the Star Hotel investment.
That's right, yes.
I don't know anything about that property at all. So my comments are about the proposition generally. It might be too late to get out of your contract. Just because you haven't paid any money doesn't mean that you might not have personal liability under the terms of the contract. So I think you need to get that checked out quickly. If then there is an opportunity for you to get out, you should, because generally speaking, I agree with Margaret, these types of investments are no good. They're no good because you're buying 22 square metres of commercial property for the return, the residential yield that you're expecting on a residential property, but as I said in relation to the car parking, it is commercial, and so you're not going to get a great uplift in value because the long-term lease that the operator of the hotel will want so that it's got a regular room bank is going to suppress your price growth. So it'll struggle to get the return that it's offering if it's anything like most of these investments around the country over the last 10 or 20 years. And even if it does, it's not going to deliver you growth as well. So I think have a good look at the contract. If there is a way out, take it. But if not, you might have to live with the decision that you've made, and hopefully you get it right next time. And
let's just again reiterate the fact that Star Hotel Apartments as an operator, we're not talking about their performance, we're not talking about anything to do with that. We don't know anything about that, and we would have just as soon not known who was going to be the operator. That's a different thing as well. The operator, it's a different agreement, isn't it? That's the actual business agreement.
And when you buy into these things, so much of what you're doing is buying into the operation. But people look at it as a property play. It's really a mixed message, and it's not a good idea for that reason. And I say that about all of them, no matter who they're operated by.
Brad, depreciation-wise, if it's a bona fide traveller's accommodation for stays of one night, maybe a 4% depreciation on the bill.
Still will struggle because officially to get the 4%, you kind of need to have more than 10 apartments in the in the project owned by yourself.
Okay.
Yeah, so you really struggle.
I didn't know that either.
It's been around. It was probably been stamped on in the last few years a little bit more. The thing is that the depreciation on them is actually quite high in comparison to the purchase price, because you've still got a stove and those things you have for one little apartment. I think that particular site, I'm somewhat aware of it, is actually an old hotel called the Star Hotel, not necessarily a service department provider building the apartments.
Yeah.
From what I understand.
But I still think at 22 square metres.
It's a hotel room.
It's a hotel.
It's a hotel room, yeah, basically. You've got finance issues. It's commercial. It's a commercial purchase, basically.
At 22 square metres, it's a panel van. You just open the door and there's a mattress, and that's it.
I think my bedroom and ensuite's bigger than that.
Okay, so I didn't realise we had a couple of comedians on the program tonight, but they're certainly welcome here. Look, Sandy, if I can just add to all of that, and Brad certainly alluded to it, your bank isn't going to like these at all. I can't imagine that they would even give you any money for it. If they did give you money for it, at best, it'll be a 50% lend, which means you've got to come up with the rest from either your own cash or equity elsewhere. They're notoriously difficult to resell. You know, there are certain parts of Sydney where it might be quirky to own a 22 square metre room, and I've seen them in the newspaper where people have, you know, a bed on a fake second level that they make to give them some room downstairs, you know, and an office underneath the bed and all that kind of thing. But in somewhere like Newcastle, I don't think people are ready in Newcastle to be buying 22 square metre rooms, and I think you're going to have trouble with capital growth there. The yield is one thing, and whether they're running service departments or just letting them out as standard residential, if they're running service departments, often the yields can be disappointing, the expenses can blow out. But I think as far as an investment goes, for those two lots of 206,000, I think you can do far better even if you do stay in Newcastle. Thanks for being here. It's time for a break, but when we return, you'll have another chance to get hold of a copy of my book, How to Achieve Property Success. But you will have to ask a question and have it selected. Call us now on 1300 30 34 35, or you can also email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it's been my pleasure to have with me on the panel tonight Michael Teys from Teys Lawyers and Brad Beer from BMT. We've been busily answering your calls, and if you do have a question, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Now, before we go to the callers, if you're in Perth, the Home Buyer Show is coming up on the 22nd and the 23rd of March. Here's your chance to pop down to the Perth Exhibition Centre and get a great dose of education from some leading property experts. It's a great weekend, and you can pick up some new skills and some ideas about investing Australia-wide. Now, I'm going to be there on both days speaking on the main stage, and I've managed to secure some free tickets just for my viewers. To get hold of yours, go to my website destiny.com.au and just click on the Home Buyer Show logo on the right-hand side of the home page. And I hope to see you all there on the weekend in Perth. Matthew from Moreno. How can we help you, Matthew?
Yeah, Moranbah, actually.
Oh, I was going to say, where the hell is Moreno? Because it's got to be the only place in Australia that I've never heard of. But I do know where Moranbah is.
Excellent. Look, I've got two questions tonight. The first one that I actually rang up about was I've got two investment properties in Brisbane, and I'm ready to start my third. And I just want to know, the whole panel seems to think Brisbane's the place to be. Is three going to be having all my eggs in one basket?
Okay.
And should I look elsewhere? And just my next question, which I just thought of while I was waiting, is for Brad, is the two properties and the third one that I'm looking at are all brand new house and plans, and for one of them, I had a depreciation report done for both, but one I sent them out to inspect the property, and the other one I just sent them information, and it was a bit cheaper. If it's a brand new property and you can give them enough information, am I better off saving that money or spending extra and sending them out to do the report?
That's a great question. So let's start with the first one. Matthew is from Moranbah. I'm not sure if he owns property there, but let's hope he doesn't, because it's not doing terribly well up in Moranbah at the moment. But he does have two in Brisbane, and Brisbane is a fabulous place, but it isn't the only fabulous place in Australia.
Exactly. And if Matthew, you've got house and land, as I heard you say, there's a whole number of ways you can diversify. You can diversify by buying different type of property, so a unit as opposed to a house, You can go to a different town, you can go to a different demographic, you can go to different age groups or special interest areas. So you can diversify without leaving Brisbane, but you certainly could leave Brisbane. There's nothing wrong with it. We always talk about land tax on this show as well. I don't know where that sits for you in Brisbane, but it's always something to keep track of. But certainly there are other places in Australia that are going to do well over the next few years, perhaps parts of Melbourne and maybe even Darwin. So they're my thoughts.
Good thoughts as well. And Brad, what about the second part of the question?
Second part of the question, you see, we like to always do an inspection on a property so we can definitely, Peter, see what's there. The concept of doing it for a little bit less money for the purpose of you sending in information and hoping that the Quantity Surveyor can actually pull everything that's a deduction out of that is something that I don't like to do. Now, the only time that goes a little bit different is if I've done a heap of these for the same guy who's building these house and land packages and I visited one exactly the same, then I don't need to necessarily go into the one that's exactly the same 5 doors up the road. So in that case, that's okay. I like to visit them. If you get an audit, I've got photographic evidence of exactly everything that was in there. And by looking through the information, if someone misses a couple of things that mean a little bit of difference in that deduction, then it's worth paying a little bit extra to make sure you get it right.
I agree. They always find things in my properties that I didn't actually know were there, even. And so I think it's really worthwhile, Matthew, having someone go out there. One of the things you should never skimp on is what you pay on a Quantity Surveyor's report. That doesn't mean you have to pay the most expensive person, but it does mean that if you're going for the really cheapy ones, you often do get what you pay for. In regard to the diversification question, I can't agree more with Michael. I think you need to diversify. You do have a lot in Brisbane, and we all think it's going to go really well, but what if we're wrong? And it doesn't go really well, and you've ended up with 3 properties there. Diversification can absolutely avoid that happening for you. And even if it does do really well, remember, your property portfolio is in place for more than just the next couple of years. There'll always be an area doing really well and another area plateauing, and it's really lovely when you've got properties all around the country and you've always got something that's growing, so there's always a way to be leveraging into more property. It's very, very important to have that diversification, and I think it's time you went out and found another area to invest. Peter from Brisbane. We've got all the callers from Brisbane tonight. How are you doing?
We're just trying to make up for the bagging we got before. No, just a query. I'm looking at buying a property at Newman in Western Australia next to Mount Whaleback, BHP's mine.
Yes.
It's $999,000 off the plan. They're a 2-storey house split into 4 one-bedroom apartments, returning just over $4,000 a week, and which works out to about $2,000 a week cash flow positive. What's your opinion on Newman and iron ore?
Okay, so I guess at the moment it is returning that amount of money. This is a difficult one to advise on because on one hand, the opportunity to get the positive $2,000 a week, whacking it directly into the property, there's $100,000 that's going to come off the principal in a year. But, Michael, there is a big downside, especially to the iron ore areas.
Yeah, look, it's I think if you were to talk to some of the people that have been in investment property advising in WA for a long time, that have been through the first round of these, you know, once-in-a-lifetime opportunities that happened 10 or 15 years ago in Port Kembla and other places. Port Kembla is not in Western Australia.
No,
that's
Karratha.
Karratha, I'm thinking
and
of.
Port
Thank you.
Hedland.
Port Hedland's the one I was thinking of. I did an investment property in Port Hedland years ago.
Port Kembla is a mining area, but it hasn't done much of it.
Yeah. So, look, I think if you were to talk to those people, they would say, look, this was the story we got 15 years ago, and people have lost money. Guess what? Rents aren't what they should have been for a whole variety of reasons. So you're talking about a big investment sum, which I think is not what we would regularly advise on this show, that you should be looking at diversification. You could take that $1 million and you could put it all around the country and have a really secure, diversified portfolio that was going to give you no grief whatsoever, and you could almost guarantee that because you'd have different properties in different places doing different things at different times. But you're going to put it under this investment strategy, you're going to put it all in one place, all eggs in one basket. Very, very high risk strategy. Don't know your circumstances and don't need to. If you've got $1 million to blow, then that's a different strategy altogether. But if not, then there are other ways to get a really good result with that amount of money.
Look, I have to entirely agree there. Brad, you're obviously in agreement on that.
Look, a fair bit of agreement, I guess. One question is it your first property, or do you own 25 other ones and you want to have a go at something that's like that, where you can actually reduce that debt fairly fast? You are taking a little bit of a punt on a mine in a wider area. The numbers sort of stack now, but it's got the risk associated definitely with that.
And look, I want you to think about another couple of things. Look around at what's happening to people already. Moranbah is where people spent $700,000-800,000 on property. They can't sell them today for $300,000, and it's been 12 months. They used to get $2,500 a week rent return. They can't rent them for $500. It turns on the face of a dime just like that. Now, we can't tell you what's going to happen in Newman. It could be the best investment you've ever made. But if Port Hedland and Karratha are anything to go by, they've already turned in those areas. Vacancies are starting to skyrocket, over 10% in Port Hedland already, and Karratha following suit, with many people who bought in at the $1 million mark already losing money hand over fist in those areas. It could turn around and come back tomorrow, or it might not. And I think what we're all in agreement on here is that if you don't mind seeing $1 million go, give it the chance and you could double your money. But if you can't afford to lose that $1 million, you need to stay out of that very, very hot kitchen. It isn't a place to be investing unless you really are okay about the potential to lose money. Thanks for being with us. We're off for a break, but when we return, you'll have another chance to ask your questions simply by calling us on 1300 30 34 35 or emailing property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and joining me tonight on the show is Michael Teys from Teys Lawyers and Brad Beer from BMT, who are both standing by, being silly too while they're doing it, to take your calls now on 1300 30 34 35 or via email property@skynews.com.au. Peter, I've been told you've got a question about Bunbury in Melbourne, and I've just been having an argument saying there is no Bunbury in Melbourne. Do you mean Bunbury Street in Footscray? Peter? Hello, Peter?
Peter's gone.
Peter's gone. Okay. Callers waiting on the line. Robert, I believe you're there, Robert.
How are you?
Hi, Robert. How you doing?
Not bad. I love your show.
Thank you. What can we do for you?
Well, I'll tell you what the problem is. I'm 60 years of age, and what's happened is that I own 8 properties, and I own them outright.
Okay.
And the thing is, I want to know from you, is it worth me to keep buying at my age at 60, or keep the properties as they are as a tax? Because I'm thinking of because of the tax down the track, or is it just I just keep the 8 properties and just try and live off the income of those properties, or do I keep going? Because I'm thinking if I keep going in another 5 years with more properties, the money's, it's just going to be, it's not going to go anywhere. It's just the kids will end up getting it. So is it worth me stopping or just keep it?
Okay.
Yeah.
So basically he wants to know whether he should keep building wealth just to leave it to those darn kids. I don't know. Do you like your kids, Robert? It's like...
yeah, I do, but I'm thinking at 60 years of age, is that too late?
Well, it depends, Robert. Are you finding it hard to have them? I mean, what else are you doing with your money?
Not a lot, really. I just put it in the bank and that's it. And I just pay the tax on it and pay all whatever it's got to be done to it, and it's just sitting there. I get good income off from the rental profile off the real estate. So, but everyone says, Rob, you need to go and buy more property so you can get the tax, because you're paying too much tax.
Okay, well, let's see what the panel has to say. I think the first thing that I would say about that is, really, it doesn't matter what anyone else says to Rob, does it? Rob can do what Rob wants. What would you do?
Rob might live till he's, 106, and probably will if you've got 8 properties at 60 and all you're worried about is paying tax. So I don't think you should worry about paying tax personally. I've always been of the view that you only pay tax if you're making money, so therefore paying tax is a good thing. And I think there is something in that. I think people do really make some emotional decisions about the tax man that just, you know, is just not worth getting concerned about. So I would have thought if you went to see a financial planner, and we're not financial planners, somebody would be taking you through those issues and asking you, you know, what do you really want from life? How do you want to spend your time? What's worrying you? What's not? But you're in a great position that lots and lots of people would like to be in, and that's because you've taken some good decisions along the way, and now's the time to really benefit from that. But I wouldn't be worried about doing or not doing anything just because of tax.
I agree. Brad?
100% agree with. Don't not do it because of tax. I think you pay tax when you make money, and even I think some of your question around if I buy more properties at the end I'm going to have to pay tax. You're probably talking about capital gains tax when you potentially sell the properties. It's still only a tax on a gain at half your marginal tax rate, so it's still on making money. Do you have enough money to comfortably do what you want to do? I guess is an important question. Go on a holiday, have some fun. I believe in fun as well, but you know, the financial planning advice that, you know, how, you know, you could live till you're 106, and is that enough to continue till that age based on the amount of money that you want to have at that age?
And I think, Brad, it raises a very serious issue for older Australians. There will be people starting their investment careers at 60. For sure.
Yeah, absolutely.
This gentleman's in a position where he's got a good portfolio at that age, but I'm sure with the way things are going and unemployment and the like, that are, you know, people that got wiped out in the GFC are going to find themselves having paid off their home and be starting an investment property when their investment portfolio when they're 60. So, you know, I think there's going to be a lot of people looking to start, not stop, at that age.
Look, I'm going to put another spin on this for you as well, Robert. I think you need a purpose. First of all, go and see a financial planner, and if you already have enough money for yourself and you don't want to leave it to the kids, why don't you start thinking about building your wealth so that you can give it all away when you die? I think that would be fabulous if you could set up a whole pile of charities, and I can help you with that because I've got many that I contribute to that are very dear to my heart, and you can set up some charitable work and think about building your portfolio toward being able to give away as much as you possibly can. Maybe that's what you need to kick you along. I think you should do what you feel like doing, Rob. If you don't want to invest anymore, don't. If you do want to invest some more, do so with some kind of real purpose in mind. Thanks for tuning in. It's time for a break, but when we return, we'll take some more calls and emails. Simply call now on 1300 30 34 35 or email us at property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it's been a great night with my expert panel. Michael Teys from Teys Lawyers and Brad Beer from BMT. We've been answering all of your calls, so if you have a question, call us now on 1300 30 34 35 or email us on property@skynews.com.au. We often get questions about bodies corporate, and this one is from Pauline, and she needs the expertise of both of my panel tonight. She says, I own a block of unit of 7 in Newtown, Toowoomba. The units could do with painting, and I'd like to present a business case going forward to the body corporate manager. It's quite a long question, and we really need to get to it, but she wants to basically know the best options for paying this and whether or not the costs are deductible, and all about adding to the strata levies. So, Michael, I'll throw this one to you.
Thank you. Well, Pauline, the issue here is that you have to attend to your repairs and maintenance. So you should be asking the body corporate manager to get on with the job. If you think it needs painting, then it needs painting, and it should be done. Part of your question is about how that should be paid. It can only be paid by a levy, and whether or not a levy is struck is not going to have any impact at all on the tax treatment of that cost. That's going to depend on how you hold the property and what you're using it for. So I hope that quick answer helps. If you need any more detail, you can get in contact with me via Margaret.
And I think too, Brad, the other thing to add to that is anything that is done of a general common ground nature to a property can become a tax deduction to you because you have a share of that common property in a body corporate.
Yeah, it's like when you buy it, from a depreciation perspective, you get to claim based on, in most states, your portion of the ownership of the common areas. And then after, when things happen, you'll have some sort of claim related to things that happen, but it depends on how you own it as to how you're going to claim those.
The question that I would like to ask very quickly, though, is if it's paid from the sinking fund as opposed to being paid from special levies, is there any difference to the depreciation treatment?
Now, special levies, they've generally already, they're going to be capital in nature, so they're going to need to depreciate over time.
Okay.
It doesn't matter where the money comes from. It's what is the nature of the expense.
Yeah.
Okay, so Pauline, definitely you need some very good advice. Give me a call or don't call me, just email me and I can certainly pass you on to Michael and we can give you some more information about that. That brings us to the end of our show. I'll be back here again next Monday and joining me then will be Ian Rodriguez from Bishop Collins and Lisa Montgomery from Resi. Thank you to my guests tonight, Michael Teys from Teys Lawyers and Brad Beer from BMT, who will of course be back again very soon. Thanks to all of our callers. Now this week our question of the week goes to Peter from Brisbane asking about Newman. Peter, I'd love you to have the book so that you can have a little read about mining towns. The book does have quite a lot of information about that. So if you'd like to email me now on yourmoneyyourcall@destiny.com.au, that should come up on your screen in a moment. yourmoneyyourcall@destiny.com.au. No, that's not it, but anyway, you'll get it. yourmoneyyourcall@destiny.com.au. I'll send you your copy of my brand new book, How to Achieve Property Success. Now you can get hold of a copy for yourself from all good bookstores and my online stall at destiny.com.au. Coming up in March, April and May is my great essential property education course, and in the next week or so we have a fabulous one happening in Adelaide. Now they are conducted all over Australia in all of our branches as well as Adelaide. Go to destiny.com.au and visit the events page to find out more. Don't forget to come and see me at the Perth Home Buyer Show this weekend, 22nd, 23rd of March down at the Perth Exhibition Centre. Go to destiny.com.au for your free tickets. You can also follow me on Twitter, Margaret Lomas AU, and on Facebook. And don't forget to come and visit me, as I said, at the Perth Home Buyer Show. Thanks for being with us. I'll see you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.